Sarah, a tutor at Accountancy Learning, and in this video I'll take you through the AAT Level 3 Management Accounting Techniques Sample Paper 2 Task 4. So this task is about the principles of budgeting and cash management. So let's look at our first question. Complete the following statement. The standard material price of a product can be established by multiplying the, and then we've got price per metre, rate per hour, by the, and we've got to choose from total number of units, quantity of material per unit, or number of label hours per unit. So we're looking at the standard material price. So looking at our options, if we're looking at the standard material price, rate per hour is not going to apply because that's labour, and neither is the number of labour hours per unit. So we're going to be taking the price per metre and we're going to multiply it by the quantity of material per unit. So how much per unit of the material does it take to make that product? For part B, we've got some true or false answers to these statements. An operating statement compares budgeted revenues and costs with standard revenues and costs. So this is false. So we're looking at an operating statement which basically breaks down the expenses into operating expenses and non-operating expenses. There is no comparison to the budget. A budget which is continually updated by adding a further accounting period is known as a rolling budget. So this is true. So this is when we continually extend the accounting period, so we add one more on so it rolls along. So that is known as a rolling budget. Now we've got some statements about liquidity. Securing a bank loan will improve the liquidity of a business. So remember, because we're talking about liquidity, we're talking about cash or the accessibility of that cash. So securing a bank loan will improve the liquidity of a business. So the bank loan will mean more cash. So that's true. The reduction of an arranged overdraft with a bank will improve the liquidity of a business. So this is still a form of lending, however, it's been reduced. So we have less overdraft on our account, which means less cash available. And the question is saying this would improve, which means it would be false, because a reduced overdraft would not improve the liquidity of a business because there is less cash available. Part D, we've got another sentence to complete, or another statement to complete. Liquidity management means the management of, and then we've got cash inflows only, cash outflows only, or both cash inflows and outflows, and the arrangement of additional finance where there is a cash, and then we've got shortfall or surplus. So liquidity management, so remember we've just said that liquidity is all about cash and availability of cash. So it means it's the management of both cash inflows and outflows, because that's what's going to affect our liquidity. If we've got money coming in, it's better. Money going out, it's reduced. And the arrangement of additional finance where there is a cash. So if we need additional finance, it means there's a shortfall. And that would all be part of liquidity management. Part E, identify by selecting add or deduct how a business reconciles profit with cash. So we're starting with the profit here at the top. And then for each of these, we need to decide whether we would add it or deduct it from profit to then reach cash. So we've got our profit figure. So loan repayments then. So this is going to be an outflow to the business because we need to pay back the loans that we've got. So therefore we would deduct from profit. Depreciation. So this is a non-cash expense. This is only reducing the carrying amount of our assets. So therefore we're going to add that back in to the profit. Purchase of non-current assets. So this is going to be an outflow. So we're going to deduct. And capital introduced from owners. So more capital is coming into the business. So it's an inflow. So we will add. And that gets us from our profit down to our cash figure. Next then, we've got some information about Me2You Limited, which is a provider of support software. The owners of the business are concerned about the cash management of the business and are reviewing the working capital requirements of the business based on information from the last 3 months. They have hired a consultant to assist them. They have been informed by the consultant that their inventory holding period is 102 days and their working capital cycle is 134 days for the 3 months ending the 31st of December 20x2. We're then given some extracts from the financial statements, so we know what our revenue is and we know what our trade receivables is. The first part of the question is we need to calculate the trade receivables collection period for the 3 months ending the 31st of December 20x2 to the nearest whole day. And we need to assume each month has 30 days. So what's our formula for the trade receivables collection period? So we are going to have our trade receivables figure and we're going to divide it by our revenue. Now before we decide what we're going to multiply it by to finish it off, it's 3 months and each month has 30 days. So we're doing this on a 90-day period. So we times it by 90, which gives us 67.4, and we're going to the nearest whole day, which is 67 days. Then the last part then is calculate the trade payables payment period for the 3 months ending the 31st of December 20x2 to the nearest whole day. So we're now looking for trade payables payment period and to the nearest whole day. Now you might immediately think, well, I can do trade payables divided by cost of sales times 90, but we haven't been given those figures. So we're not going to be able to use this formula. So what else we can do is use our working capital cycle. So our working capital cycle is our trade receivable days plus our inventory holding days less our trade payables days. So working capital cycle. So remember we were given this in the question and we've got 134 days. So 134 days. We've got 67 days for our trade receivables from the first part of this question. Inventory holding, we're told at the top in the question, is 102 days. And we need to work out our trade payables day. So now we can rearrange this formula to make it the trade payables days equals 67 plus 102 minus 134, which gives us 35 days. And that brings us to the end of task 4.